Hi everyone, time really flies. It's time for us to look at the quarter 3 2022. Where are the financial markets are heading in the remaining of 2022? So far, as of 6th of June, we see most of the equity markets in the world are going down. So now, what one should do in these rainy days? We heard a lot of the contradictory opinion were expressed by Greek financial institutions. And so one should have his own skill to interpret what exactly is happening. We see some very interesting statements are getting out from the top financial institution heads and investment managers. First one is bearish or challenging economic outlook are expressed by these famous financial institution heads, and World Bank presidents have mentioned the word stagflation is really a threat to the world economy. Second point that we always take note is the leading cryptocurrency Bitcoin has undergone great selling pressures, and a lot of the bullish will have turned bearish. And I see this is a good indicator for excessive liquidity to be the past event. The third statement is a famous US hedge fund founder has said something like that cash is rubbish and now equity even more rubbish. But for non-US dollar as home currency investors, the US dollar index has appreciated around 6.5% year to date as of June. So it's not really that rubbish for non-US dollar investors. And according to the Washington Surface data, this is the first time since March 2022 more insider is buying and is more than they're selling. So we see you need skills to survive and stand still and head ups, So, and again, you need to have your skill. Let's see what kind of event recently happened that need our special attention. ESG has been a big theme for quite a while, but we see not all the financial managers are practicing this kind of investment discipline well. And we have to be aware the possibility of overselling the ESG theme. Second event is Mundi warned about some part of the private equity market resemble Ponzi schemes. That is quite serious, but another evidence that this is the consequence of withdrawal of excessive liquidity. The third event, IMF have issued a working paper talking about the erosion of dollar dominance, saying that in the last 15-20 years, the percentage of US dollar asset in a central bank's reserve currency have dropped around 10%. You like it or not, this diversification trend is ongoing. The fourth event is there are non-stop political plays among US, Europe, China, Russia, and with the Ukraine and Russia war an ongoing event, we cannot ignore the negative impacts on global business and economy. And we did see political policy nowadays will really exert impact to the equities and bond market. So our outlook for Q3 of 2022. We see this is a quite a bearish and really challenging economic condition. And it will last for quite a while. And big institutions have been well prepared for a larger fall in the financial assets. Maybe it's time for you to dig deep into your favorite investment targets for mid and long-term horizon investment. Second thing, we see withdrawal of global liquidity will be continued amid the higher CPI in the major economies. So US dollar still stays stronger and US interest rate will remain on an upward trend. So we're still cautious towards the liquidity sensitive sectors such as the new economy and the cryptocurrency universe. We see China financial markets need to consolidate further. Of course, we see some fine-tuning announcement, and we need to see more of this coming and more consolidation happening. Again, it's time to dig deep for value buy. Hong Kong definitely will benefit from China market recovery. And deglobalization trend remain intact. Geopolitical risks remain high. And financial markets remain vulnerable to these potential shocks. So what is our homework for morphing during Q3? We see we need to justify of all the high valuation stocks that are holding by us. Not many actually. And the second point that we need to do further work is also need to justify higher yielding stocks because the income prospect already damaged. So we should pick a big question mark how to maintain the yield of a company. Third thing we would like to study more, well, in a rising bond yield environment, what kind of bond or REIT we should hold and buy. And the fourth thing is we have to think deep about mark-to-market impacts on our asset valuations. And we may see a lot of margin calls on borrowing. So a lot of highly geared investor, I think for example, some mortgage loans will be called in this kind of rising interest rate environment. We have to take note. And our asset allocation and planning in the Q3, there are 4 key points. We are very gradually will be rebuilding our equity holdings. And we are searching for growth REITs or good value bonds to buy. And we already lower our intrinsic gearing in our investment portfolios. And our wives for the retirees are very risk averse, and we need to undertake excessive pressure or not. If not necessary, no need to force oneself to take excessive risk or to guess the market trends. My friend posed me 4 questions and would like to have my response to these questions. Assuming the investor know what they want and have independent thinking. The first question is, people are generally pessimistic on outlook of financial markets to deliver 6 to 8% return going forward. Yes, I think what one need to take note is, what is your time horizon for the new investment that you are making? And does this investment match your life cycle? And overall speaking, what is your total portfolio is delivering at the moment? As I said in our drill investment philosophy, big fortune cannot make in a rush. And also, we have to take note, our life is not last forever. So we invest to the extent that match our risk and return profile. I think that is more important for individual investors. So 6 to 8% whether important or not, I think for a long-term investor, it doesn't matter, because you have a total portfolio that already perform more than one investment cycles. Second question is the rising geopolitical risk and climate change. Yes, these factors are forcing countries, company sectors, themes to go in a synchronized cycle that people are talk about it. And just like, in a small town, different kind of people should have different faith and different luck pattern during a period of time. But when only there's a big earthquake or any military attack on that small town, then everyone's fate will be tied together. So we have to be careful on how to see this is happening to the sectors, to the countries, to the company. And of course, ESG is not an excuse for underperformance. So again, it's not easy. We have to stick to our own investment style, and that could generate long-term, promising, and sustainable return for us. Third questions. Now we see the global equities ETF is generally better for many individual investors in the past 5-10 years. Is it time for us to have more active managed life cycle products, and they can manage it for us? My answer would be, how about the managing skill of the fund manager? How reliable and what's the track record? It always depends on the fund manager's skill and how much trust you have, and can you follow closely what the fund manager performance is. So it again depends on how much transparency on how they manage the fund, and the liquidity barrier when you want to withdraw or redeem. And then again, you always can have some for diversification. As I said, if you have to do some loss cutting or profit locking, is it enough liquidity? So never say never. A good diversification, if it's a good track record fund manager, a good product. So, but most people, ETF in this very down market, no harm to have a investment in this kind of well-diversified ETF and low cost. Fourth questions. So I'll take on private assets and private non-listed REITs, especially there's some scandal happening. my answer is quite similar to the last question. We can have some diversification if we really confirm the manager have a good track record, good transparency, and good redemption liquidity, and reasonable cost. And we can have the energy to follow closely. But of course, it should not be a big chunk of your assets. Okay, so now what conscientious individual investor will do now? I think one should review their existing total portfolio, including all asset class, and re-examine their total absolute loss tolerance on each asset class, review their asset allocation, and rebuild their portfolio composition if necessary. Time is for searching for mid-long-term investment target in all asset class. And conscientious investors need to develop their own skill, starting with a scientific methodology such as ours through investment philosophy. Another coming video will talk about how investors in the Greater China area could do to protect their assets in this very dynamic, maybe unstable geopolitical risk environment. It's worthwhile to revisit our drill explanation, and thank you for your patience. The following slides are some snapshots for people who would like to have a better view on what we have talked about. Thank you.